Hey, everybody, we are going to talk about some stocks you may not have heard of and that are kind of small and interesting businesses and businesses that we think have a lot of the characteristics that we like as value investors, as people who follow Warren Buffett's strategy, things that Buffett would like, but maybe wouldn't invest in because they're a little too small and wouldn't barely make a dent. Even if he bought the whole company, these might not make a dent. So Tyler Crowe is joining me. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from our sponsor, The Motley Fool. It's the best way to support this work we are doing on YouTube. Again, fool.com/Frankel. So, Tyler, I know you're definitely a value investor at heart. Um, you are, if you were managing Warren Buffett's portfolio, I have to imagine it would have a lot of companies we would never have heard of before. So if you were managing Buffett's portfolio, but maybe it was a tenth of its current size, what's a stock that you might consider for it?
So I actually love this exercise because if you think about, there's kind of like do what Buffett says, not what Buffett does, because he's been saying for years, like, look, there's probably like a handful of companies that I can buy that actually move the needle for me. But, if I was starting from scratch and only had to like manage $1 million, I could do infinitely better. And it's kind of in that vein of like, there is a lot of companies that probably would meet the criteria for a Buffett style Berkshire Hathaway, kind of investment, but not necessarily anything that he can touch right now because it's too small and really wouldn't meet the needle. But we're individuals. We're not managing $270 billion of cash and treasuries, so we can. So let's look for those kind of companies. And the one that kind of calls to me in this sense is, you think about good growth, solid economic moat, if you will, and kind of in also thinking about like as Buffett would buy the entire company versus like just buying its stock. He's basically like doesn't wants a really hands-off approach to it, and you kind of trust management. And that's why I want to look at Terreno Realty. Terreno Realty is an industrial real estate investment trust that it basically, it's kind of in the name. When I said industrial, kind of gives it away. It's warehouses, light manufacturing, a lot of things like that. But one of the things that I've always appreciated about Terreno specifically is they have a very disciplined criteria for what they want to do. They're not out there trying to like build and grow as fast as they can. They really want to focus on what they call basically shrinking markets. Basically markets where it's a very dense urban area where a lot of things that used to be previously zoned for industrial real estate is now kind of being rezoned for commercial or mixed or anything like that. And so you have this shrinking supply of industrial real estate for distribution, for all the things that you actually, still need in these areas. So they focus specifically on 6 markets: Seattle, the Bay Area of San Francisco, Los Angeles area, New York metropolitan area, Washington D.C., and Miami. All of these areas kind of they have a shrinking net supply of industrial real estate, and as a result, you tend to have higher occupancy rates. You can tend to grow or you can increase your rents at a much faster rate than say like the national average, and it's been a higher return industry for them in general. Since they went public in about 2010, they've been able to grow their same store net operating income, basically like raising the rents. They've been able to, on average, since 2010, been able to grow it by 11.3% annually, and the total growth for the business, not including its dividend, has been about 10.4% since its inception in 2010 as a publicly traded entity. Like I said, one of the reasons that I enjoy this one more, or I'm attracted to Terreno much more so than a lot of the other industrial real estate companies. Like I said, they tend to be much more disciplined and they care intensely about the per share value of the business, like your stake in the business as the net asset value per share. And it's how management is actually compensated to grow the business. It's not necessarily like have as much distributable or have like the most funds from operation as possible or anything like that. It's to grow the net asset value per share of this business so that you're growing uh, your stake in this business rather than, a lot of what you get is very like, I guess you could call them empire builders, if you will, where they tend to take on a little bit more debt. Maybe they underwrite a little bit more loosely because they get to show growth. But that's something that this company has eschewed for a long time. And it's really, I think it's worked for them. And from an investment standpoint, if I'm looking to make that Buffett style investment where I want to really hold for a long time, this is the type of management that I want to trust with my money over the long term.
So I'm going to go in a little bit different direction. Kind of maybe it's weird that I'm not the one bringing a real estate stock to the table, but I want to talk about a business that has a lot of characteristics Buffett likes. It's a capital light business. It's very profitable. It's kind of a unique recession resistant business. It's called Winmark. Ticker symbol is WINA. And you might not be familiar with the Winmark name, but you probably have heard of at least a couple of its brands. It specializes in stores that sell secondhand goods. Play It Again Sports is one of its big brands. Um, Once Upon a Child, which from a parent's perspective has been an absolute blessing to have near us. Um, I don't know if there's a Once Upon a Child where you are, Tyler, but it
Now
when
we
you
just have a network of parents who pass things around
well,
to each other.
when your kids are outgrowing things every few months, um, it can be a great, it literally cuts our clothing budget into like a fifth of what it would be. And a lot of the time you go there and it's stuff that is like, used once and then a kid outgrew it. There's another brand called Plato's Closet, which is essentially Once Upon a Child for adults. There's a used music business, things like that. It's been around since the 1980s. There are a little over 1,300 total locations of all these businesses combined. They're all franchises. All of them are operated by franchisees. And there are some really unique aspects to this business. Because of the franchise model, it doesn't really cost Winmark anything to open a new location. It needs to find a franchisee, which, I mean, there's some marketing costs involved in that. But really, someone's paying a franchise fee and paying to rent a space. And there's no need to provide inventory because it's all used items. Once Upon a Child relies on parents bringing their kids old clothes and selling them to them. There's no need to do any type of inventory management. It is a recession resistant business. It's a bargain focused business. When people need to cut back, even people who love going and getting their kids brand new clothes now, if tough times hit where if they need to cut back, Once Upon a Child's a perfect fit. Parents who have kids who play little league, who need all kinds of different equipment, and if they're anything like my kids, honestly, don't take the best care of it. You're going to buy used equipment. So because of that, it's naturally recession resistant. I want to say recession proof because most of it is still discretionary items. You don't need baseball equipment. You don't need, it's a discretionary purchase. Um, the profit margins on this, because of that capital light nature, are outstanding. A 95% gross margin, a 49% net profit margin. The only other businesses I know in that realm are like Visa and MasterCard that have almost no overhead expenses. Definitely nothing else in the apparel business. So the management team is fantastic. It's been the same. The co-founder, or I'm sorry, the business's founder has retired, but there's the same kind of three people in the top spots: the CEO, the CFO, and the COO. They all have significant ownership. They've all done a great job of running the business. They've all been with the company. The newest of the three joined the company in 2008. So they've all kind of have a lot of experience running this together. The results have been great. And I mean, there's a lot to like about this. And it's not the 1,300 locations might sound like it's a mature business, but that's between 5 resale brands. And there are still, as of right now, there are 2,800 available territories to franchise. So it could still be a lot of growth ahead. Tyler, any thoughts on Winmark?
No, it's one of those businesses where I always want to look at it again. Tends to sometimes be a little bit more expensive than I want to jump on. But when you have that sort of model, it's going to be priced at a premium. And one of the things I've been surprised at is on the Play It Again sports side, and this is because it's the side I've seen, is they actually have a pretty robust e-commerce platform, which you wouldn't expect from a used, a business or reselling sports equipment. I had seen a few startups in this area, especially around golf. But when I started digging into Play It Again Sports to see that they had a rather robust e-commerce platform, I was quite surprised, and especially the business model that they have, which, for this kind of business, I think is an absolute must-have, and I think is going to give them even more of a leg up in this industry where, margins aren't that great, but hey, man, it's franchising.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from the popular product Stock Advisor. Stock Advisor has beaten the market by nearly 5 times. So go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 767% as of July 5th, 2024, and are measured against the S&P 500 returns of 163% as of July 5th, 2024.